So I get this question a lot. Should I use annuities? I've heard so many bad things about annuities. I've heard people say I should never get an annuity. I've heard people say annuities should be considered in retirement. Well, the thing about annuities is they're not right for everyone. Hi, I'm Don Chamberlin. I'm a Certified Financial Fiduciary, which means I am legally bound to act in your best interest. Over the past 2 decades, I've helped thousands of people plan and maximize their retirement income. This channel is specifically designed for you and your retirement journey. The truth is, the best retirement income solution is a personalized one. It's designed for you and your life, nobody else's. Learn key strategies to avoid costly mistakes and secure your retirement savings. Ready to define your retirement dreams and make it happen? Like this video, subscribe to the channel, and share it with your friends. An annuity is just a tool that you can use in your retirement to potentially give you more stability for your income and have your assets last longer, possibly. So let's talk about annuities. So there's 2 types of annuities. The first type of annuity is something called a variable annuity, and many people are, and some people call them VAs, so I'll just put that on here. Many people are familiar with variable annuities. What this is it has mutual funds in it, and it goes up and down with the market, and mostly up now because the stock market's been doing pretty well lately. So people like the growth in this very much. They really like the growth. The issue that we have is when people come into the office and talk to us about this, or we talk to them over Zoom, because we're in many states in the country now, they don't like the fact that the fees are very high. We're finding variable annuities that have 3 to 4% annual fees. The next type of annuity is called a fixed annuity. And the fixed annuity is similar to a CD from the standpoint it has a fixed rate. CDs are guaranteed by FDIC. Fixed annuities are guaranteed by the insurance company and the industry as a whole. So what the fixed annuity companies came up with, because these were getting so much better returns, was a hybrid. And they call it a fixed indexed annuity. It kind of fits in the middle here. And people like this because it's safer, right, than the other one, because there are guarantees involved. But in recent years, they haven't liked the rates as much. Really past years, the rates have gone up lately, but past years for sure they haven't liked the rates. So they came up with these fixed indexed annuities, and what's happening with it is you get some interesting combinations of both of these. You actually get a better growth than what you would on the fixed annuity, and you have low to no fees. Well, I guess that's a positive, right? But with any of the annuities, a negative is the access. Typically, you can only take out about 10% per year from these. A lot of people come in with the misconception that my money's locked in. So we structure it so that people are taking out 5% or 10%, and they have plenty of other liquid assets in their emergency fund and in their growth fund. We call that the now bucket and the later bucket. So the majority of their money is not in the annuity. There are other assets to consider to use in the soon bucket for income as well. Let me show you a little bit more about how a fixed indexed annuity works. So with a fixed indexed annuity, we'll just put it up here. We'll just put it as an FIA. So with the fixed indexed annuity, what you have is you have something called an annual reset. With the annual reset, it locks in your gain each and every year, and it's linked to a market index. The most common one is the S&P 500, but there are many, many others. I'm just going to put and etc. here because there's many indexes that they can be linked to. So let's take an example. I'm just going to start with a small example here of $100,000. And let's say that your fixed indexed annuity goes up 5% the first year. Now we're seeing rates and illustrations that are showing returns that are much higher than this, but it was only maybe about 3 or 4 years ago that we were using a number 3% here. So rates right now are very good for these particular type of annuities. So after the first year, you're going to have about 105% in there. Actually, that's exactly what it would be. And then what happens is it locks in. So even if the stock market goes down the whole rest of your life, you're never going to have less than this $105,000 we put here. Let's say the next year it goes up another 5%. You're going to have some compound interest, so you're going to have something north of $110,000 in that annuity at that time. But the market doesn't always go up, does it? It goes down too. So let's say the next year the stock market actually goes down. Your interest is linked to this market index. So what happens is the annual reset that I mentioned locks in your gain. So now you still have $110,000. And if you were down here, usually we're using this to take income out of, you would have to have a gain all the way back to here just to get even. Now let's say you're actually taking income out of it while it's going down too. You'd actually have to go further down here because you can't not take the income and start from here to go up to get even. But with the fixed index annuity and the lock-in feature of the annual reset, you're here. So the worst scenario you have is that you took your income out of here. Let's say you took $10,000 worth of income that year, you'd have $100,000, right? That's just if you're taking income. In this scenario, we're not taking income yet. So you start from here and you go up, and now if you had another 5% the next year, you're somewhere around $115,000, and that locks in. So let's take a closer look at how this actually works. There's many companies that do this that are very highly rated and well respected, but usually the best value you can get with benefits and rates is to have a 10-year annuity. The longer you go, the higher the rates are that you're going to get, and most of the companies have structured it for 10 years now. When I started doing this 22 years ago, we had 16-year, we had 18-year annuities. People had, I never did a 20-year annuity, but they were out there in the marketplace. So we're happy to be able to just limit it to 10 years, and you can take out your interest from the fixed account in these annuities every year. This is how your liquidity is accessed. You take out set payments, and this is the way we structure income for people in our holistic plans. They can take set payments out every year to supplement their Social Security, to supplement their pensions. You can take out 10% per year, each and every year. If you are terminally ill, you can take out more than that 10% based on the company. If you had to go into a nursing home, you can take out more based on the company. Sometimes it's 100% for either one of those. Sometimes it's 20% instead of 10. You just have to look at what the company says. But the most important thing that we make sure of with every annuity company that we work with, because some of them don't allow this, is you get 100% access for your beneficiaries if you die before the 10-year period is up. The fixed indexed annuity can be a tool that can help us stabilize your income in retirement. It's not the only tool that you can use for this, but when we educate clients on this, most of the time they want to learn more about the annuity and see if it's right for them and their family. So this is the way annuities work. The question mark is still there. Is it right for you or not? We're not sure, but we'll continue to educate you on this subject and see if it's something that would fit in to your retirement plan. Thanks so much for watching this video. I hope you found it valuable for your journey to fulfill your retirement. Remember, your retirement dreams are closer than you think. Don't wait to build the retirement you deserve. Take action right now. If this video resonated with you, hit that like button, subscribe so you don't miss future videos that are packed with retirement wisdom, and share this video with your friends that want to learn more about how they can maximize their retirements. I'm Don Chamberlin, your Certified Financial Fiduciary. Until next time, take care.